Hello, everyone. Happy Monday. Today on the final bar, we will talk about it. The roller coaster ride of the S&P today, opening lower, rallying into the afternoon session, but closing back at the lows of the day, really giving back all of the retracement it had tried to play out. Energy leading the way higher, certainly the story of the day, followed by financials, a rotation away from technology and consumer discretionary at the bottom of the list. You have this big move away from the FANG stocks, away from semiconductors, into things like regional banks, energy stocks, E&P names, all of that and more. We'll dig into those charts and those themes as much as we can. Ladies and gentlemen, this is the final bar. Hello, everyone. Welcome to the final bar. My name is Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a rainy Redmond, Washington. Thanks for joining us every weekday after the close as we break down these markets together using technical analysis, behavioral finance, investor psychology, momentum investing, trend following, whatever we can do to try to make sense of things. And in preparing for the show, my cup runneth over of charts and themes to lay into. So we're going to do our best to cover as much ground as we can. There's certainly a rotation happening, a leadership movement. We've talked about the lagging nature of the FANG stocks, the FANMAG stocks, and how it's, those tech consumer communication names all sort of at the lower end of the range, very few of them breaking higher. We've now seen a continued rotation through today with areas like energy, financials doing just fine. So the small cap index up while everything else was down. Now those are sort of overweighted on things like financials. So when you look at the regional banks index, the KRE ETF, for example, incredible breakout, nice sustained move. Now on Mondays, we go through a couple different phases: macro analysis, sector rotation, bottom up stock picking. When we get to some of the individual names toward the end of the show, I'll hit on as many as I can and hit on some key levels I think you want to keep in mind going through this week to see whether or not this is the beginning of something deeper or not. Now we have some fantastic guests coming through the final bar. It's not just me to help you make sense of things. Tomorrow on the 23rd, we have Keith Fitzgerald from the Fitzgerald Group here in the Seattle area. On Wednesday, Tim Tashler from Sprott Global. So most likely a little more of a materials, metals focus to that discussion. And then on Thursday, the 25th, Cliff Drove. Now, I actually look at our schedule. Cliff was last on the show mid-March of 2020, a couple days before the low. And I'm not kidding. One of his quotes on the show was, "We're very, very close to the panic low," and talked about breadth and the new lows index and why that was something he was looking at. And sure enough, we were about a week away from the March 23rd low. So very keen on getting Cliff back on the show this week and see what he's looking at right now. Let's get to our show today. Looking at our market recap, we'll hit on as many of these big picture themes as we can. Again, on Monday, we start macro, then we go sectors, then we go stocks. We'll hit on as many key charts as we can along the way. The S&P finishing weaker today, and if you look at the chart of the Dow, it's probably the most exaggerated. Lower open, a nice rally into the afternoon, but then giving back much of that. So the Dow actually finished just above the zero level, but the S&P, the damage was done closing around 38.76 or so. The NASDAQ really leading the way lower, though. Technology was the worst of the 11 S&P sectors. The NASDAQ 100 down 2.6% today. Mid-caps down about 1/3%. Small caps, one of the few in the positive, up 0.6%. And the VIX is back above 23 today. In terms of bonds, continued weakness in the bond markets, with the TLT continuing to go lower, down about 0.75%. 10-year yields nearing the 1.4% mark, closing around 137. Commodities, gold and silver, both pretty positive. We've seen a bit of a divergence with silver starting, that has been working. Gold has not, but they're all sort of up together today. So very few commodities down, most of them up today, with energy leading the way higher. The DBC, the broad commodity index that we track, up to 2.25%. So certainly you've seen strength in silver. You've seen that continued today. And again, a rotation away from growth stocks and into some of these other assets. If you like volatility, I'm sure you've enjoyed the last 48 to 72 hours looking at cryptocurrencies. Bitcoin in particular was down significantly, touched around 49,000, just below that a little earlier today. This is after rallying and touching 58,000 yesterday. So really gave back a lot of that today, losing about 9,000 points in a couple in about half a day, rallying back up currently around 54,000, but net down about 6% from yesterday's close. From Friday's close, forgive me. Let's continue on talking about the macro themes. We'll look at as many of these as we can. So when you look at the S&P 500, we've talked about the challenges to the equity markets in terms of upside from here. I was interviewed earlier today on for Reuters and was asked about just the overall market conditions, rising rates, inflationary concerns, and just what investor behavior can tell us about this. And my points were basically that my analog for this year is sort of 2010. You had the big low in 2009. 2010 was a choppy, more volatile year with a couple down moves, one in the first quarter, if I remember right, and then another one in the fall. But in the end, closed higher for the year. And I think that's not a bad analog for what we might see this year. Certainly, we have been seeing the signs of rotation, right? The FANG trade working until it didn't. Markets going higher, but a lot of bearish divergences. And you can see with the S&P itself, we've had lower peaks in momentum while we've had higher peaks in the S&P's value. Overall, that is not terribly constructive. That's more of a negative sign suggesting weakness internally. Now, you haven't seen huge negativity from all the breadth indicators, certainly from some, and we talked about that on Friday's show in particular. You have, and last week a couple times, right? You have things like the bullish percent index, which is back below 70, which is actually more of a, it's called a bear alert. It's indicating potential further weakness. You've had the S&P, if you take the trend line from the October lows, and the trend line worked beautifully here in December and January, we broke down through that, tested the 50 day, and now tested that trend line from below, and now rolling over. I've redrawn a trend line using the October low and the January low from the end of January. And I think that, along with the 50-day moving average, just below 3,800 right now, I think would be a really interesting point to watch. The second real line in the sand would be around 3,700. That's the low from January. You make another new low there, break below that interim low, and I think you'll see a lot of stocks have weakened fairly significantly to the point that you could see further downside coming. So, I think we're seeing weakness here, but we're certainly seeing rotation, right? The market can come off. Certain stocks can do just fine. And again, if you look in financials, if you look in energy, some of the charts are just are fantastic. Even outside of there, if you look at the chart of Disney, for example, bouncing up today very nicely. If you look at some others, we'll get to in the stock selection part of the show, the shifting stocks segment, we'll look at some of those individual names that are working. So don't get me wrong, there are stocks that are doing just fine. But overall, we've seen some internal weakness. We've seen some signs of weakness. Groups like semiconductors that concern me a bit, and we'll look at that here next. When I'm looking at the SMH, again, it's not bad yet. It's just less good. You've had the semiconductor index make a new high about a week ago, new all-time high, new 52-week high for the SMH. We have seen at the same time, though, this weakening, right? This internal weakening, this weakening of momentum. So semiconductors going higher on lower momentum, similar to what we saw with the S&P overall. But I think that divergence has been exaggerated on things like semiconductors, on energy stocks, on financials. Now, all of these, many of these have gone higher today, but semiconductors in particular certainly establishing its most recent swing high on lower momentum. So while it's still early days, while it's still nowhere near its 50-day moving average, while it still hasn't broken its last swing low, all of those things would have to happen for me to get really concerned about the market environment from here. But, certainly suggesting we're at the, at a point where a pullback would be absolutely reasonable, if not, should be expected given the rally on lighter momentum that we've seen pretty much across the board. Now, what else can we do to try to qualify that, determine whether or not that's the case? Well, if we look here at our breadth indicators, I mentioned the bullish percent index. We'll look at this one here. This is the percent of S&P stocks in a buy signal using the point and figure charts, right? So how many are in a buy signal versus a sell signal most recently? It's just back below 70%, which is called a bear alert, right? When you have over 70%, then it comes back down. That tells you that, again, the market's rallying each of these times, but less and less S&P names are getting back to a point and figure buy signal. So they're really not rotating materially higher. They're just, the market is going higher, but with less stocks participating, which is actually, again, a sign of internal weakness. Even though the S&P was down today, we have one more chart I want to show here, then we'll get to sectors. When you look at how many stocks were up or down today, this is just the daily advances or decliners. It was literally about 50-50. So even though the market was down, there were about half the stocks closed higher today. And again, it's a lot in financials and energy. It's those late cyclical sectors that did okay today. So this was not a broad decline. This is not the market signaling a major top necessarily. This is about half the stocks actually gaining on Friday's close today. So it is more of a rotation at this point. However, this is how a more meaningful downtrend could start, is this sort of rotation. The large cap growth trade really comes off, and then the market can't hold up given the weight on some of these big technology stocks that have propelled us to where we are today. That's our big picture routine. Again, we didn't get to Bitcoin, which has been incredibly choppy, but overall, I think the trend certainly seems to be positive, and I think the buying power that came into Bitcoin just today should be an interesting indication of the pent up demand that is still there. Bond markets are what were really weak, and we talked about the TLT. We talked about financials doing well. Bond prices really continuing lower recently. Let's continue on to our next segment, sector setups. This is where we look at the 11 S&P sectors and try to pick out some of the key themes at work. This is how the long-term RRG, this is the relative rotation graph. This is how this has played out recently. Again, if you're interested in this sort of visualization, which I'm a huge follower of, and I have been for years and years, check out Julius DeKempener's show, Sector Spotlight. He does a really good job of breaking down the methodology and how to use this sort of visualization. But things tend to rotate in a clockwise direction. Furthest to the right means it's outperforming. Further to the left means it's underperforming. And sectors tend to rotate in a clockwise motion around the benchmark, which is here at the crosshairs in the middle. Two outliers that are the strength in the market, and they have been for a while, according to this methodology: energy and financials. You can see they're actually both rotating more in a easterly direction. Northeast is sort of the direction you want things to go. That is improving relative strength on improving momentum. Heading southwest is really negative. That's deteriorating, getting weaker on a relative basis, and the momentum's decreasing, or momentum's increasing on the downside, I should say. So what is really working? Energy, financials. What has been starting to emerge? Things like technology and communication services. What has actually absolutely not been working? Consumer staples and utilities, which are here in the lagging quadrant. So only 4 sectors in the leading quadrant, and 2 are the clear outliers, energy and financials. We've talked about the strength in these sectors. We've talked about how they have been emerging. So the move that you saw today, I think, is just the latest step in a series of steps that those sectors have been taking. And if you look at a chart of the financial sector and the energy sector, we'll look one at a time here. The 2-year view on financials just shows you this basing pattern, as with many, things like technology round-tripped from the February or January peak to the March low and back to their peak much more quickly than something like the XLF did. But once again, it's hit its February 2020 high, pulled back to the 50-day, and now once again has resolved to the upside. So that's an improving price chart. That's an improving relative strength chart, making a new 12-month, almost call it an 11-month relative high today. Pretty decent rotation and continued strength there. Energy, when you look at energy stocks, you're seeing a lot of really sustained rallies. They had been breakouts that have continued, and it's not just, Chevron, which, mega cap stock in the space with a nice long-term trend. It's a lot of smaller mid-cap names in there as well. We'll try to get to a couple of those when we get down there. All of these, if I would summarize them, setting up very well, nice price trend, nice relative trend, pretty much every single one of them. And that's not true, but many of them, like Occidental comes to mind, has a bearish divergence. That's OXY. The concern I have with a lot of energy charts, just like the S&P making higher peaks on weaker momentum, you're seeing that here. And while that's not the end of the world, I think the long-term trend could still be positive. The market, you'd want the market to rally on improving momentum, not weakening momentum. And that's unfortunately what we're seeing with a lot of these charts right now. Having said that, it's a classic cup and handle pattern, which is a big rounded bottom. You retest that rim of the cup or the peak, the resistance level. You have a shallower pullback. you break above that level. And if you do the traditional measuring technique, take the height of the pattern, these things measure much higher. Financials had a pattern like this, energy now having a pattern like this. And overall, I think there's more upside to be had, that especially on a relative basis. If you want to think about sector rotation and where to be leaning, I would be leaning into sectors that are outperforming, like the XLE is. I would be remaining far away from sectors like consumer staples, where the relative strength is down and has been for quite a while. Now, there are pockets of a sector like consumer staples which are fine. And when you're looking at there, we don't have a ton of time to look at it. Like tobacco stocks come to mind, right? Something like MO has had a nice run, Altria, right? Actually a decent chart in any sector, but especially in consumer staples where the average chart looks pretty weak, it's actually setting up pretty well. But this is a sector that has had lower lows and lower highs since peaking out really in November. Had a similar peak, sort of retested that level in December, and since then has been rolling lower. So while it's not the worst chart ever envisioned, it's a lot weaker than the other charts that we've been looking at in terms of financials, energy, even something like technology. Now, the concern I would have on things like technology and discretionary is we're nearing some support levels. And again, it's still early on. I mean, the chart of consumer discretionary is not horrible yet. And by Charles Dow's definition, we're still in an uptrend, making higher highs and higher lows. When a chart like this stops making higher highs and stops making higher lows, then I think you have a very valid concern and should be thinking about downside risk potential and thinking about what sort of bets you would want to be making on here. The concern I have looking at a chart of the XLY is that the relative strength has stabilized. You've had an accumulation phase going through the October peak. You then have this sideways phase. I mean, if you start the clock in October, it's essentially been a market performer. It hasn't been underperforming necessarily, but it's been a market performer. And now we're seeing it once again roll over. If we break to a new 6-month relative low, which we're pretty close to making, I'd be questioning whether or not it's a good bet relative to some of these other places we've been looking at. Same with technology. This is the XLK. And again, it's not horrible yet, right? The chart is still pretty good. And when I'm looking at the semiconductor index, it's not a horrible chart yet. It's a chart pulling back within a well-established uptrend. I think that's what we're seeing with something like technology. We break the 50-day moving average. We break, these swing lows on the XLK. I think you start to, and we make new relative lows. That's another key thing I would be looking at. Then you can start thinking about a broader rotation away from growth into value or into other asset classes and how you'd want to think about it. But at this point, still could be actionable pullbacks within long-term uptrends. We need to take a quick commercial break. Back with our next segment, Shifting Stocks. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. It's so good to have you join us every weekday after the close as we look at the technical themes of the day. Mondays are a fun ride, but a quick one through so many different charts. I usually have a couple hundred charts I love to get through, and we get through some of those, but I hope it's an interesting walk through some of the key themes of the day. As a reminder, we'll do another mailbag segment in tomorrow's show on Tuesday. So we'd love to answer one of your questions on the air. Get your questions to us via email, thefinalbar@stockcharts.com, or on Twitter @finalbarsctv. Finally, on our YouTube channel, just put a comment below the video that you're watching. We'll gather as many questions as we can. Hope to answer one of your questions on the air on Tuesday's show. Our next segment is called Shifting Stocks. So we talked about the big picture, the market going higher, but overall weakening today with momentum, divergences appearing in many, many different parts of the equity space. Breadth conditions mixed with some still okay, like advanced decliners, but some a little more concerning, like bullish percent index. We talk about sectors and this general rotation away from growth into value, which we've been addressing for, I feel like, months, thinking about the reemergence of the energy and financials trade. But when I'm looking at the market from a bottom-up perspective, looking at stocks, that's where you're finding the strength, right? The really good charts in a lot of ways are in energy and in financials, but they're also in other sectors. And I would argue even sectors that are not my favorite, I bet I could still find a couple charts that actually look pretty good And so there are opportunities across the board. Don't feel like it's, if you miss one sector, you're going to miss out on everything. Make sure you have a good discipline for looking across the equity landscape and focusing on where the opportunities might be. What I wanted to do is just share with you some of the charts that came up in my own process, looking at a bunch of charts over the weekend into this morning on Monday. We're going to start with Disney. So I usually start in the communication services sector, and when I got to the chart of Disney this morning on the big jump, I picked at it again, and this is what this market could be doing. A sort of Disney is an example of what's happening. Disney has been in a nice long-term run. The concern I saw with the rally into the mid-February peak is the weaker momentum. This is a momentum divergence we've mentioned a number of times, and we've seen on a number of the charts today. But then you have a day like today after a bit of a pullback where we resolve higher. So charts like this can shrug off bearish divergences. Tesla, certainly did that a number of times on its exponential rise to newer and newer heights. So it's not like it can't happen. And in the communication services sector, I should mention, I'm seeing a lot of charts that have had incredible runs that just continue to go on. Something like Discovery, DISCA comes to mind. Viacom would be maybe another example of that. This sort of chart. And, I'm often asked, is it too late to buy something like Viacom? And I won't comment on this one in particular. I will tell you, you could say it was too late any of these other times as the market, as it made a new 52-week high and then just kept going. There's one thing that I've learned from this market over the last year is that just because something makes a new 52-week high does not mean by any means that it may be over, right? Never confuse the top of the page with resistance. So I would not argue that on its own is not a reason to not buy a particular stock or buy a particular chart. Focus on the long-term trends, and as a trend follower, lean into trends that are working and just have a good exit strategy, right? Have a trailing stop on something like this to get out if and when things start to roll over. So overall, I should say in communication services, a lot of good charts. IPG and others have had nice pullbacks, Fox in these really nice runs. So what are some areas of potential concern? Pullback today in some of the video game makers. So, I talked on my YouTube channel, it's called Market Misbehavior, a couple of weeks ago, maybe 2 weeks ago, about Take-Two and the weakness there, testing its 50-day. Now you're seeing today EA and Activision both pulling back a little bit. And again, it's still early on. I mean, these trends are not broken yet, but these have had really good runs. And when you have a big down day like this, a 4% down day after very few of those for months and months, it certainly grabs my attention. So as with anything like this, looking to see if it holds the 50-day, holds its previous swing low. Those are the things you'll hear me say a lot. As long as those things hold, I think these could be viable pullbacks within longer term trends. You start failing at those levels, you are unable to hold support, making lower highs on a next rally. I think that's where you have to be potentially concerned. Other charts to pay attention to: Facebook testing its 200-day moving average. The last time this happened was in mid-January, and it was a nice bounce, returning near previous highs, but not quite making it. Overall, this chart is not a great chart. And the most recent rally that we saw the RSI fail at 60. And that's happened actually a bunch of times in the last 6 months. Overall, this is a stock more in a bearish trend than a bullish trend by RSI's definition. And so I think it's something you avoid until buyers are able to prove themselves, right? At this point, there's more selling pressure than buying power. And I think that's evident on the chart. Netflix is another one testing its 50-day right now. Netflix overall has been range bound. It broke out of that in mid-January, but coming back. So there are none of the Fang Man or Fan Mag, whatever we call them, stocks that I would say look particularly compelling at this point. Overall, I think there are bluer waters elsewhere, if you will. Now, within consumer discretionary, a lot of really good charts. And we don't have time to go through all of them, but Gap, Borg Warner, what else comes to mind? I don't think I meant that one. I think I meant this one. There we go, Borg Warner. I mean, not bad setups. There's some nice setup, sort of nice bases potentially breaking out. I think are pretty interesting charts that I would be worried about or thinking about. Tesla is certainly one of them. Now, this is a stock we talked about last week. Is it able to hold the 50-day? Today, the answer appears to be no. And so, that's certainly a cause for concern. In the tactical time frame, we've now made a lower high, we've made a lower low, which means in the short-term time frame, this stock is technically in a downtrend. RSI failed at 40. We talked about that last week, how it held 40 in October when it broke the 50-day, but held up in a bullish momentum structure. That may be changing. We may be having a change of character here with Tesla rotating to more of a negative overall trend. Now, again, it's all about whether it's able to hold support. I would argue it started to fail there, and I would be looking at something like Fibonacci retracements to identify some key support levels, because the problem is there's not much support-wise below where we're at right now. So I think that sort of stock is something I'd be lightening up on or leaning away from overall until the trend can prove itself. Nike is another one with the RSI failing at 60, breaking back below its 50-day moving average that I would be concerned to see if that's going to hold up or not. Starbucks is another one. So a series of these consumer discretionary stocks, not horrible yet, but failing to go to new highs. They've changed from making consistent to new highs to not making a new high on weakening momentum. And that is the sign of internal weakness, not strength. Now, where you are seeing plenty of weakness, gaming stocks, things like Wynn and Las Vegas Sands breaking out to the upside. Travel stocks like Hilton and Marriott, pretty solid breakouts. Airlines all going. So the travel trade back on, following through today, and something like Marriott, on Friday really started to break above and close above its December peak, following through today. And I think those have potentially more room to run. Where else can we go in such a limited time? Etsy may be one within consumer discretionary that I would highlight. Again, it's not a broken chart, and this would be the type of chart I might watch. It was down pretty good today, just over 6%. That doesn't make me feel good. The bearish divergence is a concern. That doesn't make me feel great either. We've broken down through trendline support. That's not a good thing, but we haven't really made a lower high. We haven't made a lower low. So again, some of these are at that could be just a short-term pullback. But I think seeing if we're able to, break the recent swing lows, I think would be pretty key. Where else did I want to go very briefly? Yeah, I would say the last thing would be within financials. I'm sorry, within technology. I'm sorry we can't get to more places, but Enphase is one stock within technology breaking down pretty good. This has been one of our top-ranked scooter ranked stocks at times, but look at how it's come off so much. It really hasn't made a lower high yet. It just stopped making higher highs, a consistent resistance level, and now breaking down through its 50-day for the first time in about 6 months. I think that's a concerning breakdown, and breaking down through recent support concerning as well. I'm very much looking at the RSI to see if it's able to hold 40 or not. The last thing, and then I'm told in my ear I need to stop talking about charts right now. Adobe, also semiconductors. Right? A lot of these stocks not horrible, but really starting to break down, especially on a relative basis. So rotation away from semiconductors into financials. That's the way I would summarize what I'm seeing right now, bottom up wise. So we need to wrap the show. 3 and 3 is like the 3 and 1 today, but here we go. We're going to do it. Chart number 1 is the S&P bullish percent index. As I mentioned, and a couple of my guests last week, we talked about this chart in some form or another, and I agree with them that we've seen a bearish divergence of higher peaks in the S&P, but lower peaks in the bullish percent index. And what that means when you have this sort of divergence, the market going higher, but less and less stocks participating. This is using point and figure charts as a proxy for the overall participation. Back below 70%, above 70% is the bullish range. That's a healthy uptrend. Between 50 and 70 is what's called a bear alert. It's not the end of the world yet, but you're starting to see some internal weakness. Breaking below 50 is where there's a concern. When you look back, those have been buyable pullbacks since the March low of last year. So worth seeing if we have a similar play out here. Chart number 2 is China. We didn't talk a lot about global markets. We had so many other things to cover, but last week we updated with these what's called accelerating trend lines, right? Steepening slope. If you take the first one, we got away from it. Take a second one, we got away from that. We take the third trend line, we just broke that today. So in the last week, you've had some choppiness and now resolving pretty well to the downside. The FXI, other Chinese ETFs, down about 3 to 4% today. So worth looking to see if you get some further downside there. Finally, the S&P Regional Banks ETF, the KRE. We didn't get to a lot of these individual charts, but when you're looking at key, Fifth Third, Huntington Banks, these are all really solid charts. Nice breakouts, continued upswing, all based on higher rates and a steepening yield curve. And the KRE certainly appears to be in an uptrend until proven otherwise. But overall, I think this is a strong trend with potential further upside right there. Folks, that is our show for today. I want to thank you so much for joining us every weekday after the close for the final bar. As a reminder, we'll do another mailbag segment on Tuesday's show. We'd love to answer one of your questions. So shoot us an email, thefinalbar@stockcharts.com. We'd love to answer one of your questions on the air. Finally, we are just releasing this week the new StockCharts TV app. Go to stockchartstv.com or go to any mobile device, Apple TV, Roku, Amazon Fire, whatever it is. Look for StockCharts TV. You'll find us there. Set up a free account Watch all of our content on demand. Enjoy and let us know what you think. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a good night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.